Hi everyone, Kathleen here, Research Director at XTB. The start of Q4 has got off with a bang, but not in the way that the bulls wanted. Stocks have been swinging wildly between gains on the back of China's stimulus measures to losses on the back of rising risk aversion as geopolitical tensions rise in the Middle East. On top of this, there is a recalibration of interest rate expectations going on. After the monster US payrolls report last month, which saw the US economy create 254,000 jobs, smashing expectations, and the unemployment rate fell back to 4%. This has led to a pricing out of rate cut expectations in the US. There's now less than 25 basis points of cuts priced in by the market for the Fed's November meeting, and there's a growing expectation that the Fed won't cut at all next month. This has pushed the 10-year US Treasury yield to above 4%, which is a psychologically important level. Part of the reason for this is that inflation fears are rising once again. Not only is the US economy strong, but oil prices have surged recently. The price of Brent crude rose by the most last week since 2009. The Brent crude oil price is now just under $80 per barrel, as the market prices in a geopolitical risk premium to the oil price, as the chance of a direct conflict between Iran and Israel grows. Later this week, the US CPI will be released. The market expects inflation to continue to moderate to 2.3 from 2.5%. If this happens, it would be a Goldilocks scenario that would allow stocks to rally, even if the US economy is running hot. However, the bigger risk for stock markets is that US inflation comes in stronger than expected, which could lead to another wave of risk aversion. The shift in interest rate expectations and the rise in risk aversion has driven interest in the US dollar. The dollar is the strongest currency in the G10 FX space this week, and the pound and the yen have been hit hard. Sterling dollar has fallen back to 131, and as US Treasury yields rise, it makes it hard for the pound to sustain a sustained recovery. Thanks everyone for joining, and see you next time.